Can you hear it clearly? The sound? So I'm using my laptop so that because we don't have a video camera here, so I put the laptop so you can see.
Maybe can you turn the volume of the computer off because suddenly it's echoing?
Uh, because if we have a question, then we need to ask. So when you are going to present, and if you have a question, what you can do, you can go off logging into your device. Can you please log into your own device, and then I'll mute the microphone here. That way that even if you have a question, you can ask straight away. So please log in with your device, and then I'm going to uh, mute my system.
Hey guys, can you still hear me?
Yes, yes, we're still here.
Great. And it looks like this is being recorded, right? So I
Yes,
guess we're all good there.
yes, is it okay?
No, that's terrific.
Yes. So now, just give me a second. Maximize it. Now, so everyone can see you. So let me just quickly introduce to Mao this class. So Mao, this is the class of ethics and finance, and the topic about the investment in ethics. The crypto cases would be absolutely brilliant case for this class. And now let me introduce Mao. Mao actually cannot introduce himself, but before he is the head of engineering of Zero Cap Limited. He got huge experience on cryptocurrencies. His entire life was dealing with the digital currency. And Mao, if I'm not making a mistake, you're currently located in the USA.
That's right. I'm currently in Boston.
And he's currently located in Boston. So you can see that that's why he cannot come to the class. That's why we're doing this online session, and this session is recorded. So Mao, if you can just give a small introduction about yourself, that would be great. And then I'm going to stop my microphone and all session will be yours.
Sounds great. Thanks, Professor. So, y'all can see my screen, right? I'm sharing.
Yes, we can see the screen. Yes.
Great. Okay. So, I think you already know what Zero Cap is. This is kind of just a quick recap. So, myself, I've worked in fintech my entire career. So I started off as a management consultant, actually working in AI, primarily working in New York with the large Wall Street investment banks, large banks in general. So I did that for a while, and then joined a startup in Chicago, so this was primarily futures, and then worked at Middlelink, where we did all kinds of middle office stuff, which is quite complicated and lots of fun. And then Neurasic was later acquired, so that was nice. And then in 2017 is when I went full time into crypto. So did that for a while, and so basically have been doing that up to now. I started by co-founding a network with a friend of mine, where we use blockchain to send payments to farmers in Nigeria. Unfortunately, that business was a failure, but it was a tremendous learning experience in many, many regards. And 2017, as some of you may recall, was one of the bigger booms of crypto. Bitcoin went from just under 1,000 to just to 20K at the peak, came back down to 3,000. And later, during the when it started going down, I joined a quantitative trading firm, Eigen Capital, and later on we partnered with Zero Cap to launch a number of products. And currently, I'm leading development and quantitative research at Zero Cap. So that's myself. And then today, we're going to look at cryptocurrency. Specifically, we're going to look at a number of case studies in cryptocurrency to learn as a way to reflect on the importance of ethics in investment. And I think that, I don't know about you guys, when I was going to school in New York, bunch of idiot classmates of mine. They all thought about Gordon Gekko, Jordan Belfort. They wanted to be all, they idolize these rich Wall Street assholes. And unfortunately, that's largely a myth. You don't really, like Goldman says, you make money by being long-term greedy. So ethics are actually quite important when it comes to having a long and productive career in the investment industry. There are a number of people that we'll talk about today that did become very rich, but guess what? They can't show their face anywhere in the world for the rest of their lives if they want to stay out of prison. So not really a great life well, I mean, I guess it's okay for some people, but not for most people, I would think. So ethics are quite important, and we're going to look at a bunch of things not to do when working in financial services. So number one, don't steal from investors. I think this should be fairly straightforward. Terrible idea. When people give you money, they are placing a tremendous amount of faith in you. And I say this as someone who has been looked after people's money for trading purposes and for investment. Has managed prop money, has been given money through fundraising for a startup. So when people give you money, that's a very special relationship, and you should not steal it. You should take very good care of it. So this is a number of crypto projects that stole massive amounts of money from investors, and really this is just the tip of the iceberg. There's a very, very, very long list of crypto projects that through various methods have stolen money from investors. Don't do it. Terrible idea. Highly illegal. Highly unethical. In crypto, this is generally called rug pulling. But it could be called anything. Doesn't really matter. So don't do it. In fact, I'll give you an example of someone I highly respect, who I think did a really good job of managing investor money, who works in crypto. And this person's name is John Whelan. And he currently is the MD for crypto assets at Santander. So him and I met when I was at Norensic. At the time, what was he doing? He was managing a website called Coinist. So you might recall that in 2016, for the most part, the crypto market was considered to be dead by a lot of people. Obviously, these people are very wrong. But John, he managed Coinist for a number of years, couldn't make any money, was maintaining it with investor money. And you see here that in Feb 2016, just before the boom, about half a year before the boom, he decided he could not, turn this into a successful company, and he closed down the business and returned 70 cents on the dollar to his investors. So they lost a lot of money. They lost 30%, but he could have spent all of the money. He didn't. I mean, in hindsight, he could have kept going. Maybe would have made money. Maybe wouldn't have. But it turns out that these people, they were all happy to. Obviously, they weren't happy, lost money, but they were happy to do business with him again, because he ultimately he did save them money, and he was upfront with the risks, and obviously currently he's been doing a great job at Santander. So don't steal from investors. Take good care of their money. Number two, don't fake your own death. This is kind of a subset of don't steal from investors. So this fellow, he ran what used to be Canada's largest crypto exchange, called Quadriga CX, until for some reason, for some reason he suddenly died while vacationing in India. And turns out that he was the only person who could move the crypto that Quadriga CX had held on behalf of its users. So many people think he faked his own death, and he now has $250 million, and he's somewhere. It could be India, it could be, obviously he's one of the people that can't show his face anywhere because he's supposed to be dead. Also, his wife, who was in Canada, now has to deal with all the legal problems, and she does not have $250 million. She has no money, in fact. So, he just, either he actually died and he left a massive mess for his partners, his investors, his customers, and his wife to deal with, or he faked his death, in which case he's a complete scumbag and a criminal. And so, even if you don't fake your own death, even if you actually die, exercise responsible corporate governance, make plans. This is what we will call it's called business continuity, right? BCP. Really boring to do, but actually quite important. Uh, Otherwise, you end up with cases like these. What else? Don't misuse investor money, right? So, okay, so you're not going to steal it, but you're going to, like this guy, they raised 15 million Droid ICO, and they took the money and they went to the beach, right? So you in this case, you are raising for a blockchain project. People expect you to spend it on, I mean, of course, some reasonable marketing expenses are fine, but generally you should be spending it on R&D or business development or doing something. I mean, in this case, you'll be doing something to increase the value of their investment into your tokens. Going to the beach probably does not help increase the value of your tokens. So don't spend it on going to the beach. And then, this is actually quite personal to me because a partner of mine at a later project, they had done an ICO and raised some money, and then they did another ICO, and they used the proceeds from the second ICO to make whole investors from the first ICO. So, I mean, this is technically embezzlement. Now, he didn't get rich. He didn't use it for himself, but it doesn't matter. The money was taken out from, not used for the appropriate project, and then basically used to fill a hole somewhere else. So don't do that either. Highly unethical. It's the main reason why I stopped working with him. Fortunately, he's still free, so good for him. But ultimately, it's really not a good thing to do. Don't run a Ponzi scheme. So, BitConnect. I don't know if any guys know crypto history. You might want to try YouTubing BitConnect at some point because the video where this comes from is actually highly entertaining. But this project was a massive Ponzi scheme. At the time, I think they stole over $100 million from users. I think at this point it's become over $2 billion using like today's prices. It's a fairly straightforward scheme, promising 1% daily compound interest, which is pretty amazing. So the BitConnect coin rose to 525 before, now it's basically worth nothing. And the worst part is the founders. Everyone and their mom knew it was a Ponzi scheme, and they came back and did it again, and they think they made money the second time too. So I guess that says something about people, but twice is way too many. One time is way too many. Don't run a Ponzi scheme. So actually, another quick story. When I was in 2019, was a very, for the most part, was a pretty boring market. So it was just horizontal. Volatility was pretty compressed. I think people were making jokes that Bitcoin was the real stable coin. So there was, you couldn't make money trading. There's no alpha. There's no arbitrage. There's no spread. There's minimal volume. No one was investing. So pretty terrible time to work in crypto. And so, unfortunately, a lot of people I knew started turning to Ponzi schemes. People were actually running Ponzi scheme workshops. People who had been experienced Ponziers were bringing people into the fold and setting up these these structures. Like some investment bankers that I knew, investment bankers in China, started getting into Ponzi's using their, basically selling to their book and trying to get out first before the rest of the money, the dumb money came in. But don't do it, terrible idea. Don't misrepresent yourself. So, in this case, for example, Alex Tapscott. I don't know if you guys know Don Tapscott. He wrote a fairly influential book called The Blockchain Revolution. The Blockchain Revolution is a very good book. Don Tapscott is a very good guy. Alex Tapscott is his son, and he raised over 100 million Canadian dollars off, basically, off like what he did, but he in his fundraising documents, he included multiple people that were not actually involved with his firm. I don't know why he did it, because he could have raised without making these claims, but he went out and did it. And ultimately, I think he managed it in a fairly reasonable way. He removed people from the deck. He personally refused to take profits from the firm. Nextblock Global ultimately made over 150% returns for its investors. So good for him. He didn't take any of the profits, and he paid a $25,000 SEC fine, and the firm was liquidated within a year. But still a pretty serious security violation. This is actually something that I did at a previous firm. Rather, not myself, but at a previous firm when we were fundraising, we sent out an email blast that made some claims that were not true. And what ended up happening is we ended up having to buy out all of the existing United States investors just to minimize our risk, which, we were basically giving their money back to them, but it was still tremendously expensive. So don't do that. Even though, especially when you're fundraising for a startup, it can get pretty desperate. You start making all kinds of claims, especially when you look at all these ridiculous claims that, change the world, Silicon Valley, whatever. But not a good idea. Violation. Also, on the other side of the aisle, I don't know if anyone has seen Squid Game. It's a popular show on Netflix. So someone made a Squid Game token that was entirely unconnected to the show. And so they raised over 3.38 million before people noticed, and they just ran off, and no one knows what happened to the token. So don't do that either. Don't promise returns. So, this is pretty common, especially for Ponzi schemes. They'll say, look at how much money you can make. It's mathematically designed to give 10 million X price increase. Well, that's a security violation. No investment is guaranteed. You cannot guarantee any returns. I guess theoretically you can. There are certain fixed income products that can guarantee returns, but actually you can't, because if your firm is insolvent, maybe those won't pan out either. You could go even further, lock the funds in escrow, etc. But even then, there's still systemic risk. So there's no investment in the world that's entirely risk-free. No investment is guaranteed. Don't promise returns. Don't put out fake news. So this is another one where no one really knows who did these, but there was someone put out a press release that said Walmart would now start accepting Litecoin, which obviously led to a massive pump for the Litecoin price. This was false. It did not actually happen. And then someone else, I think shortly after, they put out a similar press release saying Kroger is accepting Bitcoin Cash. Also false. But this publication itself they actually just reported it. They said Kroger is accepting Bitcoin Cash, had to retract this article. So yeah, don't do it. These days with everything that Elon Musk is doing, it's kind of, it seems like if you're rich enough, you can get away with it. I don't know if he's really going to get away with it, but it doesn't matter. He shouldn't be doing it either, and none of us are Elon Musk. So don't put out fake news. Don't put out fake news that's not financial in nature either. In general, fake news is bad for the world. Don't fake your trading volume. So a very common tactic for both crypto token projects and exchanges is to fake volume. So, if you're a token, you're out there, you finally got on the exchange, and no one's trading your token, it looks bad, and it makes people, not want to buy your token. Same deal if you're an exchange. So you've gone out, you've made an exchange, open your door, hung out your shingle, and no one's trading there. It looks bad. So a lot of people, they'll just fake volume. This is fraud, because you are, even if you hire someone else to do it, you're representing something that should not be happening. Even if someone is doing it without your knowledge, in the United States, I don't know as much about Europe or APAC or wherever. In the United States, if you run an exchange, then you have an obligation to detect and stamp out wash trading, as well as a whole bunch of other kinds of market manipulative behavior. When you are an exchange, you are an SRO. You're a self-regulatory organization, and these are things that you need to do. So this is from a really interesting presentation from Bitwise back in 2019 when they were applying for a Bitcoin ETF from the SEC. and they said, they did all kinds of really interesting analysis. So this is what organic trading volume looks like. It's spiky. Sometimes when volatility is high, trading volume is high. Sometimes it's just not there. This is what trading volume looks like for a fake exchange. So it's very unnatural, very geometric, very volatile. Well, also volatile, but in the wrong way. So these are fake. There's a whole lot more that are fake. This is also fraud. Even if you are not doing it, you should take action to get rid of it. If you ever run an exchange, don't trade against your users as an exchange. So this is kind of a serious allegation. Obviously, as an exchange, you are expected to be a neutral party for everyone. In fact, in the United States, which is the regulatory regime I'm most familiar with, there's actually with the Reg NMS, there are very, very specific rules you need to follow to make it a fair venue for everyone. So if you're an equities exchange and someone fills on your exchange, not you, but the other person, the trader, the trader, the taker is entitled to receive the best national best bid and offer. So if your price is worse than someone else, they filled on your exchange at that point in time, then they are entitled to a better price. Which means that you really need to have really fast price feeds. Otherwise, you're just going to be sitting ducks for HFTs. So as an exchange, you have very stringent obligations to be neutral. So obviously, if you start prop trading against your own users, that's unethical on numerous different levels. And I know for a fact that at least one crypto exchange, a fairly large one, had a substantial prop trading team. And when I was working, I still work at Capital, but in 2018 and 2019, because we were pretty well known in Beijing, at least, as a crypto quant trading team. And at least 3 people have approached me over the years and said something along the lines of, "Hey, I'm starting a futures exchange. Why don't you come on and trade against your users?" So when you're a futures exchange, you know everything. Your client's margin. You know what their P&L is. You know what their stop loss is. A lot of futures on crypto they're trading perpetual futures, so you're trading on leverage, so you know exactly how to hit them with a margin call. Also, when it's your own exchange, you manage the index price, so you can, if it's quarterly, you can deliver wherever you want. You can affect the funding to basically bleed them out slowly. You have infinite leverage, infinite capital, so you have the deck is stacked pretty heavily in your favor if you're trading against your users as an exchange, which is why you're not supposed to do it. We did not do any of these because it's illegal, and we enjoy hanging out in the United States. However, in November 2018, Amber, which is a pretty well-known trading firm, they accused OKX of manipulating prices, leading to a fairly strong loss of their own. OKX denied the allegations, obviously, and had a few points of their own. So I don't know. No one really knows if they were trading against them or not. Maybe they were, maybe they weren't. But don't do it. Not a good thing to do. The flip side of this is don't trade against your own investors. So this is a pretty classic pump and dump. Basically what happens is the insiders, they would buy in over time, be somewhere over here, and then they would just drive up hype. So what happens is that people start seeing the price going up, they start buying in. This is also sometimes called momentum ignition, which is also illegal. And then the insiders, they start selling over here. Well, I mean, basically, if you bought before this line, this vertical line, then anytime you sell over Monday, Tuesday, Wednesday, you're making money. It just depends how much money you're making. So this is the basic mechanics of a pump and dump. So these were extensively portrayed in Wolf of Wall Street, being executed by Jordan Belfort. Jordan Belfort is a convicted criminal, who couldn't make it on Wall Street, which is why he had to do these pump and dumps. He was running what used to be called, what was it called? a boiler room operation, which means that you just shove a bunch of traders into a room. It's boiling hot. You can't afford AC, and you go out and just con people all day long. So he's a loser. I don't know why people like him. The movie is about how crime doesn't pay, lose everything you made, don't trade against your investors. Terrible idea. You're basically stealing. You're basically stealing from your investors. Um, be very careful when you're promoting investments. So these are all well-known people. You know, Matt Damon, Kim Kardashian, DJ Khaled, De'Aaron Fox, NBA player. You know, boxing champion, streamer, Mark Cuban. These are all people who, in the last like 2 years, have been promoting some kind of crypto. I mean, Matt Damon's a little bit better. He's just making a commercial. Everyone else has been basically like shilling a token, and all these tokens, every single one of them has basically gone to zero. So, you know, like, who knows what they were doing? I mean, I would bet that they were probably just paid to run a commercial, except for this guy. It seems like he actually had this token. But everyone else, I mean, Mark Cuban too. I guess he lost money too. But everyone else, I would bet they probably just got paid and didn't really think about it, which is stupid. You know, like if you're gonna promote an investment, I mean, like promoting, let's say you're promoting smart water. I mean, I guess that's okay. You know, if you're promoting a skincare product doesn't work, that's really pretty bad. Uh, Promoting a financial investment is pretty bad. You know, you lose money pretty directly. So, you know, yeah, don't do it. I don't know if these guys were fine or not. Probably were. Most importantly, especially if you want to work in crypto, don't let your funds be stolen. So there's a crypto game called Axie Infinity. They got hacked. They lost over 600 million. And also for this game, what they promised was being able to use crypto to lift yourself out of poverty. So most of the funds were given to them by, you know, just retail traders, people off the street in the Philippines. So 600 million in the Philippines goes a lot further than 600 million in the United States or Australia. It's it's a lot of money to a lot of people. There's a good friend of mine who's a crypto OG over in the Philippines who was playing this game for a long time and was talking with his audience, and you know they lost all their money. So it doesn't seem like Axie Infinity stole from themselves. It just seems that they were dumb or unfortunate, you know. But it doesn't really matter, you know, whether ultimately when you take custody of customer funds, you have an obligation to keep it safe. And so it's easier said than done, you know, like there's all kinds of hacks out there. It's like cybersecurity is a very, very sophisticated space, but and I'm sure they tried to keep it safe. It's not like they just like open the door and let people take the money. But still, you know, and also this has happened like every year, I think. Every year there are all kinds of hacks in crypto. You know, when you get hacked in crypto, you can't get your money back. It's pretty simple. Um, Very rarely can you get your money back. So, you know, don't lose the money. So that's it. You know, that's a whole bunch of ways that you can be unethical in crypto. And let's see if you have any questions.
Thank you, Mal, for your presentation. You know, you explained so many things about the cryptocurrency and the fraud, what really happened and other things. Now, I got one question, like, you know, you talk about the one coin and other coin, all those Ponzi schemes. Uh, you know, so did they find it out? You know, did the, you know, there's all those investors, they invested their money in those Ponzi scheme or all this, you know, one coin, did they get the money back?
Sorry, what's the question? Like, did they find out who did it?
So, you know, what was the punishment happened to these people who run the Ponzi scheme or like, you know, the one-com scam? What was the punishment for them? And for the investor, did they receive some type of compensation?
So the short answer is no punishment, no compensation. So for one coin was actually run by a ring. And so several of these people were actually caught and put in jail. I think they managed to recover about 500 million of the 4 billion.
Okay.
But this person, the CEO, is still at large. and obviously that's majority of the funds are still out there. I think for these guys, I mean, this one, you know, no one ever found who they were. I think for Pincoin, they were maybe able to find one of them. But long story short, these guys got away. So, which by the way is not really. It might seem like they stole a bunch of money and they're able to go out, live on their money for the rest of their lives, but it's really not that simple. Like think about how much you take for granted when you go on a plane, you take the bus, when you go to dinner, like sign up for Facebook. Do you really want to be on the run for the rest of your life? Do you really want to like not be able to return to Australia, return to China, return to the United States because you're a wanted person? Do you want to spend the rest of your life looking around the corner thinking like that person in the cafe might be working for the FBI or Interpol or whatever? So even though these are successful scams, and what can they do? They can like live in a village in Thailand and change their identity for the rest of their lives. There's some people, it's been proven that sociopaths they feel less stressed than other people, which is why they make great soldiers and so on. So maybe these people, maybe they don't feel that stressed. Maybe they're okay. Maybe they're really happy about it. These guys seem happy, right? But are you that kind of person? If you're a real sociopath, you feel like this is the path for you. There's nothing I can say to convince you not to do it. But if you're not, and most people aren't, then it's a pretty stressful lifestyle, even with all that money.
Do anyone have any question? You have a question? Yeah, you can just unmute your mic and ask the question from there.
Hello, can you hear me?
Yep. What would you say is one of the most advantageous points? Wait, how do I get back to chat? Okay. What would you say is one of the most advantageous points in investing in cryptocurrency instead of other investment products? I mean, that's a really good question. So, cryptocurrency is a very complicated asset class. It's actually not an asset class. It's really it's more like a theme. It's like investing in emerging markets. So, if think about it, what would you say? What is the advantageous point in investing in emerging markets instead of in Australia? Well, like EM bonds have higher yields. They're somewhat uncorrelated. I mean, they're more correlated now. They used to be uncorrelated. You can get asymmetric returns when you invest in EM. And it's the same deal for crypto. So crypto has a long track record of having asymmetric and really quite high returns. If you just held Bitcoin, you have a Sharp of 0.7, like 0.7 to 0.8, which is quite high. It's obviously could be higher, but for like one of the dumbest strategies you could have, it's a pretty reasonable Sharp. It has pretty high. At times it could have high volatility, and so you can do all kinds of things with volatility. Obviously, you can just trade it. You can kind of like sell options or put together structured products and take advantage of the implied volatility. There's like investing in tokens is kind of like it is actually kind of like VC for everyone. With VC, what happens is you invest in X amount of projects, expecting most of them to fail, and one of them will give you 10x returns. Tokens are like you invest in 100 products and 100 tokens, 99 will fail, but one will give you 1000x returns. So that's what tokens are like, which it is a way to make money. It is kind of uncorrelated to like the S&P. It gives you asymmetric returns. It's fun too to trade crypto. So I think you really have to treat it as just an emerging theme, as and then just kind of look specifically at the products that you want to invest in and see what you can do there. No problem.
Now, Mark, I've got another question. Like in this class, we talk about the ethics and international finance. Uh, I'm an academic and I mainly teach the finance. So the topic I teach basically capital market, advanced finance, valuation models, all those topics. Now, the finance asset, we always look at the valuation model. So what is actually the valuation for a particular product? For example, it could be share, it could be debenture, it could be any other financial instruments. Look at the valuation and look at the market if there is any difference in valuation, and then we invest on the product. That okay, so this is undervalued or this is overvalued. We look at the valuation, look at the product, and then we advise to go for the investment in the particular product. Now, in cryptocurrency, I understand that there is no valuation model. There's no valuations, all based on, I would say, emotion and hype. Is there any way you can value any particular cryptocurrency?
Yeah, so I mean, it's another great question. If you knew how to do it, you should go start a hedge fund, make a ton of money, and if you have a good valuation model. But I think it's also kind of a larger question because, like, what asset is not driven by emotion and hype? Every asset, especially equities, but even commodities are highly driven by emotion and hype and sentiment. So crypto is not different in that regard. Now, I will say that, like you think about stuff like, Benjamin Graham style, like fundamental value investing. Um, you know, Me personally, I don't think that's very effective in crypto. I think that looking at the fundamentals of some of these tokens is generally not very effective. But that's just my personal opinion. Obviously, there's a lot of people, even at zero cap, who will look at the fundamentals extensively and have found some success. So, there's probably something going on there. One thing I will say that's incredibly obvious is that crypto is highly, highly cyclical. So if we look at like, and also like the other thing have to know about about crypto is that everything is highly correlated to Bitcoin. So if you look at the history of crypto, I mean, number one, if you look at the history of Bitcoin, you're basically looking at the history of crypto. Number two, if you zoom out again, you can see that it's really just a series of boom bust cycles. And if you like take these cycles, if you like straighten them out, so if you lengthen them and you normalize them and you put them against each other, each cycle is actually quite similar to the next cycle. So, and also these cycles are pretty more or less detached from global macroeconomic cycles. Now, they're probably going to get more correlated in the future, or maybe not. I don't know, but it does seem like in that sense, crypto is kind of just doing its own thing. That's not really correlated with any other asset class or market regime. So I would say that, and there are theoretical reasons for why there are these cycles. It's very similar to like any kind of gold rush, where you have a free market, you have a lot of hype. The hype emerges, some people make money. There's oversupply, which crashes the market, and then it happens again as people find the next place for a gold rush. Like you see gold rush kind of behavior in all kinds of assets as well. Like you see it, like for example, just a few years ago, between like I would say 2010 to 2018, the days of the Vision Fund, the 100 billion fund investing massive amounts in Uber and Lyft and all kinds of companies. I think that was a good example of a gold rush where everyone just started piling in on these Silicon Valley startups. If you took the valuations there and you mapped them against Bitcoin, they would actually probably look quite similar. People may not know this, but like the Nasdaq started as like a rival index to the NYSE, and it also went through like boom bust cycles and ultimately became a mainstay of modern finance. If you take the Nasdaq and then normalize it and you map it against Bitcoin, it also looks quite similar. So I think that if you like research the boom bust, the cyclical nature of crypto, especially of Bitcoin, And then you basically like, and then you want, let's say you may want to make a valuation model for some other token, then just kind of look at how that token differs or is similar to Bitcoin. I think it'll probably end up with a pretty solid model. It is ultimately a very macro model, so you couldn't really use it for any kind of medium term or short term trading. But I think it will give you a pretty good understanding of the market. The other side of the coin is if you want to look at short term or medium term, which is really more of what we do on a day-to-day basis, then I've seen lots of people make all kinds of models, use deep learning, on-chain indicators, all kinds of weird stuff, sentiment analysis over and over again. For the most part, what I've seen be most effective is really two strategies. Is one, you either like try to predict when people are moving tokens to sell them. Moving tokens to buy is trickier because people could be moving like dollar tokens, and there's all kinds of reasons why people move dollar tokens. But like, for example, if the project team has 10 million tokens and they move them all to exchange, well, what do you think they're going to do? Like, why did they take them out and put them to exchange? Probably gonna sell them, right? So that was one strategy, but that strategy, like the alpha has been squeezed out. Too many people know about it. The other thing is to look at market microstructure. So really like trying to dig into the order book, how it changes, trying to dig into like tick by tick, kind of how like DEF is moving around. Now crypto is unregulated, so you have a lot of weird behavior, like spoofing, layering, momentum ignition, fake trading, wash trading. So there's a lot of stuff going on there. But in my experience, using these like using order book indicators and short-term indicators is the most effective way to build a successful short-term strategy. So, but it's a very tricky subject.
Thank you very much. Now I just got a very quick, simple question. Maybe you can answer it very quickly. I can see there is a comment in here. I said, when do you think that Bitcoin will reach 200K? Instead of reaching 200K, we can see that Bitcoin actually from 20K, it's from 78K down to about 20K. So there's a heavily volatile. We talk about that, the Bitcoin is like, you mentioned two things. There is a cycle. If you can explain that cycle, because I couldn't see the cycle on the graph. Second thing, you mentioned about the gold rush, because the gold, there is a commodity, there's an asset. So if it looks like the gold rush, so I think that for the Bitcoin or the cryptocurrency, then the boom has been busted already, because from 78,000, about 70K, it dropped to around 20K. So do you think the boom has been busted?
Yeah, I mean, I think it's pretty obvious that the bubble has been busted for this recent cycle. I think we're going to be in this market for another 3 to 4 years, just trading in a range, just going up and down for a while. It's going to be very, very boring. But at some point it'll probably come back up again. I mean, obviously inflation is quite high, which is kind of like even adjusted for inflation, there are still cycles, but it's definitely contributing to the price rise. Like when are we going to hit 200K? Well, first of all, don't promise returns, so I have no idea when we'll hit 200K. But I think it's probably an interesting quant modeling exercise. Just like take out like these boom busts, try to figure out like the easiest way to do it, or rather the simplest way to do it. Try to figure out when we enter a bull, when we exit a bear, like find out how many days in between. You could just use the all-time high to the all-time low, or find out like when the slope exceeds 45% or whatever, and then like figure out like what the multiplier is between the all-time high for each cycle, and then find the find a derivative, the first derivative. So that's the slope, the rate of change for the all-time highs. And then you can just extrapolate that to find out when we hit 200K. So, pretty basic calculus, pretty basic quant modeling. I don't know, I mean, probably in 10 years, I guess.
Okay.
So I'm going to guess somewhere in that range.
So, thank you very much, Mark, for your excellent presentation. Any question you want to have? Last question. So, all right, so Mark, there is no question. Thank you very much for your time. Thank you very much for joining from the USA. So the presentation was excellent. Can we give him a big hand? Thank you, Mao. We really enjoyed it. And is it okay that if I share the presentation, is it okay if you can share the presentation slide with me?
Sure thing.
Yeah, so if you can send me the slide through email, I can share with the students, and if they have any questions, they can probably get back to you. Or they can send me the question, I can send it to you back. So thank you.
Sounds great.
Thank you, Mao. Yeah, thank you very much. Enjoy the rest of the day. Really appreciate your presentation, and hopefully we'll meet again.
Sounds good. All right, guys. Hope you had fun. Talk to you later.
Thank you. Bye. All right. Great.